Hello everyone, this is Gracie here. So in this video we will be discussing about IFRS 10 consolidated financial statement. So in IFRS 3 we would have discussed about business combination where when a parent is acquiring its subsidiary. So when it becomes a parent and subsidiary is when you acquire all the assets and liabilities of that particular firm. The 50% of major holdings is done, then it will be called as parent company, and the company, the entity which is selling its assets and liabilities to the parent is called as your subsidiary company. So there in IFRS 3 we need to disclose the information about your parents and subsidiary, what are the assets and liabilities being sold out between two parent and subsidiary. But here IFRS 10 is consolidated financial statement, so it is nothing but your accounting procedures. How are you going to account the parent and subsidiaries consolidated financial statements. So in this, IFRS 10 was issued in May 2011, and it applies to annual periods, which is beginning from 1st January 2013. So why this IFRS consolidated financial statement states that the requirement for the preparation and presentation of consolidated financial statements requiring entity to consolidate entities its control. So where there will be right over the parent company to its subsidiary companies. So here IFRS 10 defines when an investor controls the investee. Your investors here are nothing but your parent and your subsidiary company. So when they have power over their financial assets and liabilities, when they start as a parent and subsidiary, they need to have one single consolidated financial statement. So what are the IFRS 10 defines when an investor controls the investee. So these are the points: when the investor is exposed or has rights to variable returns from its involvement with the investee. Yes, when a parent company acquires all the assets and liabilities, and it has right over the various returns, and it has involvements over various investees asset and liabilities, then investor has control over their investees and has the ability to affect those returns through its power over the investee. Yes, once a parent company is acquired and a consideration is paid to the investees or the subsidiary company, then they have the right over it, where the power is given to the investors, and the investee can act as a suggestion maker for the investor. Investor controls the investee when he has all the three elements: power over the investee, exposure or rights to variable returns from its involvement with the investee, the ability to use its power over the investee to affect the amount of investors' returns. Yes, when everything is acquired, the assets and liabilities are acquired, the shares are also acquired. So the shares of subsidiary companies become the share of the parent company, where here the parent company has a major holdings of the subsidiary. It acts as a power maker, or the power or judgment. They decide about their investors return. So a subsidiary acts as a suggestion maker here, where the power is over the investor or the parent company. So here it gives an treatment or accounting requirements for the preparation of consolidated financial statement. Your non-controlling interest, as I've explained about non-controlling interest, as every firm as its shareholders, subsidiary companies also will have their shareholders. So their interests here are called as your non-controlling interest, which is already explained in your previous videos. So their accounting requirements will be explained in IFRS 10. So IFRS 10 also contains special accounting requirements for investment entities. So where an entity meets the definition of investment entity is, so when investment entity, it is called they have special treatment. Here subsidiary, parent and subsidiary companies prepare consolidated financial statement. Investment entity treatment is also given in IFRS 10, but it is totally different from your parent and subsidiary, where there is no need for investment and entity to prepare consolidated statement, because the treatment for it is totally different. But it has been stated in your IFRS 10 how to treat investment entities. Here an investment entity means which obtains funds from one or more investors for the purpose of providing those investors with investment management services. So this meaning is totally different from parent and subsidiary, where this is just an investment activity which has been carried out in order to raise funds. So such firms are called here as investment entity. The second point commits to its investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. So their main aim is to run their business or to improve their business and to invest their funds to gather money from different sectors in order to form capital appreciation and to earn income. Measures and evaluates the performance of substantially all of its investment on fair value basis. Yes, and their task or objective is to give good returns for the investments, what they have received for their business for their business appreciation, in order to give good returns for their investors. So this is the meaning of investment entity here. The main aim of IFRS 10 is to prepare, or it's an accounting procedure for to prepare a consolidated financial statement, the financial statement of the parent and subsidiary company. Apart from that, it has a special feature where it also helps or gives a guidelines for the treatment of investment entity, and the meaning of investment entity is given in this paragraph. IFRS 11 Joint Arrangements. So IFRS 11 sets principle for reporting of joint arrangements of which two parties or more parties have joint control. So when you are getting into a business where you have made an agreement between two parties to start up your business who has the same assessment or same aim to accomplish, then you get into a joint business with two or more parties in order to achieve the same goal. When your interests are similar, then you make an agreement between two parties to achieve it together in order to earn a good return. So when your business entity is into any joint venture or joint operation, you are supposed to adopt IFRS 11 principles, which helps you in reporting or your accounting treatment in your financial statement. How are you going to recognize such income or such business performance in your financial statement? So here it explains, IFRS 11 explains characteristics of joint control. The parties are bound by contractual arrangement. Yes, they get into a contract between and make an agreement to run up their business or to start up their entities. The contractual arrangement gives two or more of those parties joint control of the arrangement. Yes, when you get into an agreement between these parties, it gives you a joint control where both have control over their agreement. Based on their agreement, the controls will be accomplished. So it gives a guidance for assessment whether joint control exists. IFRS 11 classifies joint assessment in two categories. When it is joint arrangements here are classified into two: joint operation and joint venture. Here, joint operation and joint venture, the difference between this is joint operation here, which represents only a share of net assets and equity accounted. This is for your joint venture. When it comes to joint operation, which represents right to assets and obligations for liabilities which are accounted accordingly. So what is the major difference between joint operation and joint venture is joint operation where the parties have right over the assets and obligation towards the liabilities only. When it comes to joint venture, where they have right or share over the net worth of that company, that is their final profit or income which is generated. They have share over the net assets and equity accounted by the company. So this is a difference where they have right over the assets and obligation towards the liabilities in your joint operation. When it's joint venture, the profit which is generated from that particular venture will be shared among the parties engaged in joint arrangement, and prescribes how each of these forms shall be recognized and reported in the financial statement. IFRS 12 disclosure of interest in other parties. So, in this standard, IFRS 12 explains that all the informations regarding disclosure of interest in other parties. That means, apart from your business, what are the other business activities and what are your incomes or expenses generated from those other parties or other entities. Entities should be disclosed in your financial statement. So what is IFRS 12 is disclosure of interest in other parties is a consolidated disclosure standard requiring a wide range of disclosures about an entity's interest in subsidiaries, joint arrangements, associates, and unconsolidated structured entities. Disclosures are presented as a series of objectives with detailed guidance on satisfying those objectives. Yes, if one entity is having business with the other entity, might be having a subsidiary or having a joint arrangement with other entity or associate, or if it is a parent and subsidiary, it prepares, if there's a business combination, it prepares a consolidated financial statement, or any business with the other entities. Such information should be disclosed in or provided in the financial statement under the head disclosure of interest with other parties. That is what IFRS 12 states here. So what this standard explains here is, or what is this objective of this standard is, the objective of IFRS 12 is to require the disclosure of information that enables users of financial statement to evaluate. So the main objective of this standard is, the financial statement which is prepared should also disclose the information of the income generated from the other business apart from their own business. So with these information, when it is generated in the financial statement, it helps the users of the financial statement. Users in the sense, it can be shareholders, it can be creditors, it can be anyone who is looking into your financial statement to evaluate what is the nature, the risk associated with and what is its interest in other entities. Then the effects of those interests on your financial statement, financial performance, and cash flows. So the risk, what is the nature, to which extent it is generating your income, or these investment in these other entities, is it improving your financial position, what is your financial performance, and how is your cash flow into this organization having business with other entities. So when these information are disclosed in a financial statement, it helps the users to evaluate your financial statement. That is what this IFRS 12 standard explains. So IFRS 12 needs to meet the above all the objectives, and entity is required to disclose whatever additional information is necessary to meet under IFRS 12. So here IFRS is required to be applied by an entity that has an interest in any of the following. That is, if they have any of the following business activities, like having subsidiaries, joint arrangements, that is nothing but joint operations or joint ventures, associates, and the other businesses when they are combined with the other entity. So IFRS 12 here, it does not apply to certain employee benefit plans, separate financial statement, separate financial statement, certain interests in joint ventures held by an entity that does not share in joint control, and the majority of interest in another entity accounted for in accordance with IFRS. So here it only has certain obligations to be satisfied. That is, any income which is generated from joint entities, that is with the other entities should be disclosed, not the information of the other entities other than your entities. The income which is generated with the combination of both the entities, only such information will be disclosed. No, it doesn't require the information of the third party or the other entities financial statement information here. So it clearly states, if any business entity which has interest over or as a business with subsidiaries, joint arrangements, associates, it need to disclose all the information or financial position in their financial statement about about might be the expenses or income generated from the business combination of these following subsidies, joint arrangements, associates, etc. So what are the incomes generated in it to be explained? So it helps the end users to know how is the financial position moving on, and with whom they have joined to run the business, and who are their subsidiaries, who are their joint ventures, who are their joint operators. So it will be easy for the users to look into that information. Thank you everyone. We will discuss the next topic in the next video.